Hey there, how's it going? This is the Federal Reserve press release, and I've already opened it. It's fresh from today, and you can get it at the Federal Reserve website. So I'm just gonna go over it. I just heard the press conference, and now I'm just going over the actual document, seeing if there's anything that I missed. I'm pretty sure there is, so I actually need to refresh this another time again. So the Federal Reserve is committed to using its full range of tools to support the US economy in this challenging time, thereby promoting its maximum employment and price stability goals. The corona outbreak is causing tremendous human and economic hardship across the US and around the world. The virus and the measures taken to protect public health have induced sharp declines in economic activities and a surge in job losses. Weaker demand and significantly lower oil prices are holding down consumer price inflation. Weaker demand, significantly lower oil prices are holding down consumer price inflation. Alright. Financial conditions have improved in part, reflecting policy measures to support the economy and the flow of the credit to U.S. households and businesses. The ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term. Alright, near term on economic activity, employment, and inflation, and poses considerable risks to the economic outlook over the medium term. In light of these developments, the committee decided to maintain the target rate for the federal fund rate at 0 to 0.25%. The committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. The committee will continue to monitor the implications of incoming information for the economic outlook, including information related to the public health, as well as global developments and muted inflation pressures, and will use its tools and act as appropriate to support the economy. In determining the timing and size of future adjustments to the stance of monetary policy, the committee will assess realized and expected economic conditions relative to its maximum employment objective and its symmetric 2%. All right, so here this is interesting. The committee will assess realized and expected economic conditions. So today's report also had this economic projections. All right, so this is very important, the economic projections. So let's take a close look at this, and I really kind of have to scrutinize this, so I might have to go over it again. The economic projections of the Federal Reserve members and the Federal Reserve presidents under their individual assumptions of projected appropriate monetary policy. Advance release, yes, okay. So median, central tendency, the range. Okay, so let's first, for each period, the median is the middle projections when the projections are arranged from lowest to highest. When the number of projections is even, the median is the average of the two middle projections. The average of the two middle projections. So we can just use the median, and the central tendency arranged for a variable in a given year includes all participants' projections from lowest to highest for that variable in that year. Alright, and the range. The range will be the range for a variable in a given year includes all participants' projections from lowest to highest, and central tendency excludes the three highest and three lowest projections for each variable in each year. Alright, so we're just gonna focus on the median, which is the middle of these two numbers here. So the change in GDP, change in real GDP. Alright, unemployment rate, PCE inflation. So PCE is personal consumption expenditure inflation, which is basically prices. and core PCE excludes food and energy. Right. So projected appropriate policy path, federal funds rate December projection. So in terms of this year, we're looking at 2020. All right. So the change in real GDP, and in the conference he was saying that he expects it to be the biggest drop that we've ever seen. So the change will be minus 6% projected for this year, but next year for this quarter it was projected to be around 5%, all things being equal. But for some reason in 2022 the projection is low, all right, and longer run, and so the range will be between this. So they're not expecting anything to be basically higher than minus 5%, and the median is 6.5%. All right. So for next year, they expect high inflations and longer run. All right. So the longer it becomes, the less the projections are. They don't want to be overly optimistic. And then minus 10 to minus 4. So let me actually check the definition of the range once again. So the central tendency, so this is the central tendency. So the central tendency excludes the 3 highest and 3 lowest projections for each variable. All right, so this excludes the 3 highest and 3 lowest, and the range for a variable in a given year includes all participants' projections from the lowest to the highest for that variable in that year. All right, so when we're looking, and longer run projections for core PCE inflation are not collected. All right, so when we look at the range, we're looking at a wider tendency, a wider trend. So this is different standard deviation basically. So this is the normal, this is the standard deviation, the first standard deviation that would be expected, and this one would be the third standard deviation. So when the economy gets to this level, in terms of us seeing a minus 10, this is going to be something that we have to look at in relation to minus 10 versus minus 7. So this is the lower band. So if, for example, we get to minus 8%, then we're in the middle of the range and the central tendency, which means that it's very bad. But if we are around minus 4 and minus 5, we're at the higher end of the spectrum of what is expected to be the projected real GDP change. If it ends up being minus 5%, then this is actually a very good outcome. So this is just how we'll see these or interpret these numbers in a basic understanding. So this is change in real GDP and December projection. So in December, this is where we're going to be looking at the whole year, which is the 4th quarter GDP. And this, I'm assuming, is the year-on-year GDP. All right. So this is the unemployment, 9.3, and could get up to 14%. And this is not the wide range of unemployment. But one thing that he was saying, and we'll look at that as I finish reading that report, is that he was saying that the unemployment is going to be affected a lot by the way the people are not going to get their jobs back. That's what he was just saying. So he expects it to be around 3.5 by December and range at 3.6, 3.7 there about, which is something that was raised by one of the reporters. They were asking how he's going to be able to have these types of projections be credible? And the answer was the economy was already doing fine. So when things are picking up again, which is something that is being said over and over again about a robust growth, when that starts happening again, then this will be visible in these numbers, because everything will just go back to normal, as he put it. So 6.5, 5.5 from 9.3, these drops will be better, and we'll see how that goes. PCE, so this is inflation, 0.8, 1.6, so the target is 2%, and this is right there. So this is the target, and the highest projected is 2.2. So that is that, and core inflation is not forecast. Yes, so in terms of inflation right now, we're deflationary, and this is something that worries the Fed a lot. They need there to be an inflation rate of around 2%. So this is what is expected, around 1.7, 1.6, which is double what we already have. So at least double the production, double the growth, which is double the inflation. So we'll see what that means as time goes on. So that's PCE inflation, and core inflation is right now at 1.1%, and is not as deflationary as the other one, but is quite deflationary, and is expected to be double-ish, not actually double, 50%. But then in terms of December projections, it will be basically what it is already. So in terms of core inflation, there's not a real problem. So the prices are stable as far as we can see. So the Fed funds rate, this is important. So they expect the rate to basically remain unchanged. So they're expecting to raise the rates maybe sometime next year to 2.5%. All right, and later on keeping on raising them. All right, so let's see. All right, medians, central tendencies, and ranges of economic projections. All right, so 2020, we are here. So this is our range. This is basically the same thing that we're looking at here. So the same way that we interpreted this is the same way that we look at this. So basically these are huge candlesticks, right? The wick will be showing us the outer bounds of the range, and then this is the median, and then this is the central tendency, basically just like a candle. So I hope that this is not hard for you to read. So this is basically that. So when you understand this information, the median, the central tendency, and the range. So this is the wick, this is the body, and this is the current price, basically. If you look at it this way, the median, and then the body here, which shows the central tendency, and then we have the range. So we'll see where we land in terms of these projections in the long term, in the long run. And here is where we really are, the change in the real GDP. So they expect a huge drop, but from this drop here, yeah, I wish I could draw on this. I'll find a pen. I don't know how to do that right now. But if it drops here, it's gonna bounce back up, and then this is how they just expect it to be. And the longer run, this is just the basic level of GDP, but there has to be a sharp increase. So this sharp increase is inevitable in a sense. So yeah, this is going to affect everything, like currencies and the S&P and everything. And this is unemployment. So right now we're here and it's spiked up, right? Or we were here in 2019, so they expect us to land somewhere here and have this cool down in the years to come. But in 2022, they don't expect there to be a cooling down as that point, you know. So they expect it to be higher, perhaps 2016, 2017 levels of unemployment, not 2019, 2020 levels. But it could spike as high as 14% in terms of the narrow range of unemployment, which is actually bad, because this is not the only way that unemployment is measured. So the real level of unemployment would be like 3-4 times worse. And yeah, so I'll show you unemployment measures, different ways of looking at it later. But just know that if it gets here, this is not a good thing. But there was some data. So there's some data from the previous week in the previous video on the jobs data. I don't know what I labeled it, but then I made a video on that one specifically because it was very, very important. Trump made a press conference. It was very shocking. Even Jerome Powell was mentioning that. Anyhow, they expect this to be a spike to this level here. The median range is actually lower. It's not actually in the middle of the body, right? This is something to notice. So there's a tendency that the jobs data will come somewhere low. So we'll see where it actually does land according to these projections. And inflation. So inflation right now is here, and they expect there to be some deflation and quick inflation back up and higher inflation. And yeah, so that's how they actually see this. So FOMC participants' assessment of appropriate monetary policy, midpoint of target range or target level for Fed funds rate. So we have 4% here, right there at the top, 0 here at the bottom. So this is 2020, and all of the presidents of the 12 federal banks in the US, all 12 of them agree that the level of the Fed's funds rate is at a right position for this year, next year, and possibly the year after. But after that, in the long term, they really want to see the rates high as 3%, as low, maybe as low as 2%. And I think this is Jerome Powell's vote right here. But yeah, it's making an interesting projection here. Okay, so yes, so this is the explanation of them, and I'm not going to read this right now because I just want us to finish this. So the committee will assess realized expected economic conditions. This assessment will take into account a wide range. So here, the committee will assess realized and expected economic conditions relative to the maximum employment objective of its symmetric 2% inflation objective. So this is what we're looking at. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and reading on inflation and international developments. All right. To support the flow of credit to households and businesses over coming months, the Fed will increase its holding of securities, treasuries, and agency residential and commercial mortgage-backed securities. So it's going to be buying assets from banks, and these mortgage-backed securities from 2008, at least at the current pace, to sustain. So this pace to sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. In addition, the open market desk will continue to offer large-scale overnight and term repurchase agreement operations. The committee will closely monitor developments and is prepared to adjust its plans as appropriate. Voting for the monetary policy action where Jerome Powell, yes, all of them. All right. The Fed has made the following decisions to implement the monetary policy stance announced by the FOMC on June 10. All right, the Board of Governors voted unanimously to maintain interest rates paid on required and excess reserve balances at 0% effective. All right, so the first point here, everyone expected this, so this is not really news. And if I do see the news, it's probably going to be talking about this. But let's see what else is here. As part of its policy decision, the FOMC voted to authorize and direct open markets desk at the Federal Reserve Bank of New York until instructed otherwise to execute transactions. So they're going to be trading on the SOMA system open account in accordance with the following domestic policy directive, effective June 11, which is tomorrow. The FOMC directs a desk too. So when the Fed trades, their trades are super wavy, you know. So the FOMC directs to undertake open market operations as necessary to maintain the federal funds rate at a target range of 0.25%, increase the system open market account holdings of Treasury Secretary's agency. So they're going to be buying more treasuries, more mortgages, and agency commercial mortgage-backed securities. So commercial and non-commercial mortgages, all right, at least at the current pace, to sustain smooth functioning of markets for these securities, thereby fostering effective transmission of monetary policy to broader financial conditions. Conduct term and overnight repurchase agreement operations to support effective policy implementation and the smooth functioning of short-term US dollar funding markets. Conduct term and overnight, so more than 24 hours. Repurchase agreement operations to support effective policy implementation and the smooth functioning of short-term USD funding markets. Okay, so there's going to be some stuff that's going to be traded on the repo market, repurchase agreement on the overnight market, which is the interbank market for US dollar funding, short-term US dollar funding. So I wonder how this is going to affect the dollar starting tomorrow. Okay, starting tomorrow, because this is based on these projections. All right, this is based on these projections. So when we see this on a chart, how is this going to apply? Like when the unemployment rate is here, usually where will the US dollar be, you know? So this is going to be affected by these trades. Open market committee directs the desk, so they have a trading desk. Okay. Conduct overnight reverse purchase agreement operations at an offering rate of 0%. And with a per counterparty limit of 30 billion per day. The per counterparty limit can be temporarily increased at the discretion of the chair. Okay, 30 billion a day. Sure. You know what? The GDP of Zimbabwe is like 30 billion. So they trade like 30 billion a day. It's a lot. And it can be increased at the discretion of the chair. You know, all of this was not mentioned in the actual conference. So yeah, this is the real deal. And roll over at auction all principal payments roll over at auction all principal payments from the Fed's holdings of Treasury securities. Roll over at auction all principal payments from the Federal Reserve's holdings of Treasury securities and reinvest all principal payments from the Federal Reserve's holdings of agency debt and agency MBS in agency MBS and all principal payments from holdings of agency CMBS in agency CMBS. Wow. This is a complicated trade that I actually don't get right now. So yeah. So roll over. So I guess this is speaking about they want to arbitrage these ones is what I'm kind of getting. So at auction principal payments from the Federal Reserve's holding of Treasury securities and reinvest all principal payments from the Federal Reserve's holdings of agency debt and agency MBS in agency MBS and all principal payments from holdings of agency CMBS in agency CMBS. So commercial mortgages and regular mortgages are going to be what? Rolled over. So this rollover is speaking about the interest differences from the treasury in comparison to the treasury securities. Wow, yeah, this actual trade is a bit complicated. Yeah. I'll have to understand it more. Allow modest deviations from stated amounts for purchases and reinvestments if needed for operational reasons. Okay, modest deviations from stated amounts. Alright, this is when you can increase your capital for purchases and reinvestments. So this is all going to be going through New York. Engage in dollar roll and coupon swap transactions as necessary to facilitate settlement of the Federal Reserve's agency MBS transactions. Engage in dollar roll and coupon swap transactions as necessary to facilitate settlement of the Fed's agency MBS transactions. Okay, so basically these mortgage-backed securities, I should say, this is what it is. It's a security backed by mortgage-backed security backed. Yeah, so you read it from here to there, but you understand it from here to here. In a related action, the Board of Governors of the Federal Reserve System voted unanimously to approve the establishment of the primary credit rate at the existing level of 0.25. This information will be updated as appropriate to reflect decisions of the Federal Open Market Committee or Board of Governors regarding details of the Federal Reserve's operational tools and approach used to implement monetary policy. More information regarding the open market operations and reinvestments may be found on the Federal Reserve Bank of New York's. So we should check out New York later. So this is basically it, and I am actually just going to read this. So the explanation of economic projections charts. The chart shows actual values and projections for 3 economic variables based on FOMC. Why don't they say this in the beginning? FOMC participants' individual assessments of appropriate monetary policy. Change in real gross domestic policy product as measured from the fourth quarter of the previous year to the fourth quarter of the year indicated. So this is a year. Unemployment rate, the average civilian unemployment rate in the fourth quarter of each year. PCE inflation as measured by the change in the personal consumption expenditures. Price index from the fourth quarter of the previous year to the fourth quarter of the year indicated. Information for these variables is shown for each year from 2015 to 2020. Okay, and for the longer run, the solid blue line labeled actual shows the historic values for each variable The solid red line depicts median projection in each period for each variable. The median value in each period is the middle projection when the projections are arranged from lowest to highest. When the number of projections is even, the median is the average of the two middle projections. The range and central tendency for each variable in each projection period are depicted in the box and whiskers format. Alright, box and whiskers, this is what they call it. So this is box and the whiskers, but this just looks like a candlestick, you know. So yeah, box and whiskers. The blue connected horizon, the vertical lines, the whiskers, represent the range of projections of policymakers. The bottom of the range for each variable is the lowest of all of the projections for that year or period. Likewise, the top of the range is the highest of all the projections for that year or period. The light blue shaded boxes represent the central tendency, which is a narrower version of the range that excludes the three highest and three lowest projections for each variable in each year or period. The longer run projections, which are shown on the far right side of the charts, so the longer run projections are the rates of growth, unemployment, and inflation to which a policymaker expects the economy to converge over time, maybe 5 or 6 years. Okay, so let's just take another look at the longer run objectives. So 5 or 6 years, unemployment back here, and so basically what we're looking at is the whole business cycle, because a business cycle takes about 8 to 12 years. This one took 11 years from 2008 2007, you know, so this one was a long cycle. So in the next 10 years there'll be another cycle which will make this number fluctuate higher again, and this one come down again, presumably. So right now all of these actions that are being taken will impact the markets for a long time. In the absence of further shocks and under appropriate monetary policy, maybe 5 or 6 years, in the absence of further shocks, yes, and under appropriate monetary policy, because appropriate monetary policy by definition is aimed at achieving the Fed's dual mandate of maximum employment and price stability. Yeah, this is like his mantra, you know. Like if he was meditating in the Himalayas, he'd be like maximum employment, price stability. That is the tone of Jerome Powell. Like this is in the press conference, this is what he keeps on saying, parrot fashion every time. Alright, in the longer run, policymakers' longer run projections for economic growth and unemployment may be interrupted respectively as estimates of the economy's normal or trend rate of growth and its normal unemployment rate over the longer run. Okay, the longer run projection shown for inflation is the rate of inflation judged to be most consistent with the Fed's dual mandate. Alright, so inflation is a very volatile topic. So yeah, we'll talk about this separately. In fact, all of these are separate. Explanation of the policy path chart. This chart is based on policymakers' assessments of appropriate monetary policy, which by definition is the future path of policy that each participant deems most likely to foster outcomes for economic activity and inflation that best satisfy his or her interpretation of the Fed's dual objective of maximum employment and stable prices. Each shaded circle indicates a value rounded to the nearest eighth percentage point of an individual participant's judgment of the midpoint of the appropriate target range for the federal funds rate, or the appropriate target level for the federal funds rate at the end of the specified calendar year or over the longer run. Okay. So that's basically it. And this is the Federal Reserve Bank of New York. And yeah, so I'm going to be keeping an eye on this site to see what else they're going to be talking about and adding on to their trades to see how that $30 billion a day is going to be moving, and how these agency mortgage-backed securities are going to be acting, so all of these. So this is where all the money is going to be balanced. I don't know how they do what they do, but this is how it's going to happen. So this is the monetary policy implementation. So this is the New York Fed is authorized by the FOMC to transact in U.S. government and agency securities, and it does this for the system open market account. So they have their own account, their own trading, their own trades to implement monetary policy directives. So yeah, so these are the transactions, these are the trades. So these trades move the market. So these trades define liquidity and illiquidity. So right now we have a lot of liquidity. So this liquidity is very important, because from what I see, it seems like there's a huge demand for dollars. So they're facilitating the need for dollars. So we'll see how it goes. And I don't know the rate at which the inflation is going to inflate the rate away. So this could mean that there is strength in the dollar in the near term, but in the long term there's more inflation. So we'll see how that unfolds. So thank you so much. I'm not going to make this longer than it already has been. So thank you for following along with me, and I'll see you soon in the next video.